Hi, I'm Mary Kopczynski, the CEO of RegAlytics, and I'm here to give you an update on this week's 32,451 alerts. And you know, I spent over a decade on Wall Street doing regulatory crisis management, and since getting into RegAlytics, I've actually quite enjoyed the break, talking about other things in financial services, but sometimes they still just catch my eye, and I've got to talk about it. So, the regulator of the week is the FDIC. The FDIC board has approved a proposed rule to modernize its broker deposit regulations. The most illuminating alert on the topic is the statement of the CFPB director, Rohit Chopra, and he's also a member of the FDIC board of directors. And here's what he said about the new rule. He said that recent events have caused the FDIC to revisit decisions made in 2020 regarding brokered deposits. A brokered deposit is a deposit that's made to a bank with the help of a third-party deposit broker. The broker might be a person, a company, or an organization, and banks often sell large denomination deposits to brokers who then divide them into smaller pieces to sell to their customers. Brokered deposits are pretty attractive to investors because they typically offer a higher interest rate, and they're attractive to banks because they get more cash on their balance sheet even though it's not direct customers that they have the relationship with. So it can sometimes be very volatile and risky. So in 2020, the FDIC changes exempted a substantial amount of brokered deposits from regulation. And instead of using it to foster long-term customer relationships, some of the banks relied on these volatile deposits. And in some cases, like Voyager and First Republic, to their detriment. So the proposed new rule is attempting to clarify the definition of deposit brokers, close loopholes from the 2020 amendments, and promote a more stable banking environment by encouraging direct relationship banking. The topic of the week is small business financing, and it's actually coming out of California. So Senate Bill 1482 at a hearing scheduled today. And this legislation, which is effective on January 1st, 2026, is going to regulate commercial financing, which will include some of these increasingly common accounts receivable purchase transactions, asset-based lending, commercial loans, and lease financing for small businesses. It, of course, requires licensing for commercial financing providers and brokers, required disclosures, and it forbids certain practices. So, the other big one I'm going to point out, and that's it for this week, is FINRA's warning about extended hours trading. Well, this practice allows retail investors to buy and sell stocks outside of regular market hours and offers convenience. It still carries some risks, including lower liquidity, increased volatility, and a potential for inferior pricing compared to regular trading hours. And of course, the official closing price is still set at 4 p.m., meaning it doesn't actually affect these prices or the next day's opening prices. So investors need to be aware of their brokerage's specific rules and risk disclosures before participating in extended hours trading. And that's it this week for RegAlytics. We have the global supply chain of the world's regulatory alerts in one very easy to use API, and we like to help people build cool stuff with it. So if you have anything that you need a solution to regulation, give us a call.